thank you for coming. Before we start, I would just like to give a quick introduction to Rethinking Economics for those of you who are new. So Rethinking Economics is an international student-led movement that aims to reform the way economics is taught and practiced. We decided to bring this movement to UCL and established UCL Rethinking Economics because we're passionate about the power of economics in bringing a positive change in society. But we also think that our restrictive curriculum needs to be reformed for this to be achieved. This event is also our attempt to bridge this gap between our lectures and the real world.
It is an honor to introduce Dr. Alberto Botta. He's an associate professor of economics at the University of Greenwich, where he's currently leading the program for MSc Economics. He specializes in structuralist and post-Keynesian macroeconomics. His research is at the forefront of addressing development issues in developing and emerging economies. He has also delved into the complexities of the eurozone crisis and financial instability, exploring potential economic institutional solutions. More recently, Dr. Botta's research has unveiled the intricacies of the shadow banking system, examined the interplay between financialization and inequality, and assessed the macroeconomic impact of quantitative easing. We are privileged to have Dr. Alberto Botta here today, offering profound insights on how financial system evolution can impact contemporary macroeconomics. Thank you, Dr. Botta, for sharing your time and expertise with me.
Well, hello everybody. First of all, thanks for the invitation. It's my pleasure being here. It's my pleasure to contribute to a new Rethinking Economic Society here at UCL. And it's my pleasure in particular because, just to let you know, there is another Rethinking Economic Society association also at the University of Greenwich. So this year in February, our students organized a kind of large student-led event precisely on these topics. After 2019, 2019 was the first event, and then there were obviously 3 years of interruption due to COVID, and I'm very much pleased that this year they managed to organize another event, and I'm very much happy that there are similar initiatives taking place here at the UCL. So I've been told to give a brief talk about the impact of financial system evolution on contemporary macroeconomics. And I tried to be as simple as possible. I don't know how many of you have a background in economics. And I tried to include in this talk some of hot topics, let's say, to connect these hot topics to history of economic thought, economic history, because in the end, I presume that if you would like to participate to Rethinking Economics activity, you are kind of interested in these kind of aspects which are increasingly neglected by most of the economics programs and curricula everywhere in the world. So I tried to include these bits about the history of economic thought, economic history, and then some aspects of my recent research activities on this topic. So let's try first of all, and please stop me whenever you want, if there is any question, if there is any doubt, if you want more details, right? I know that at the end of the presentation there will be a Q&A session, but feel free to intervene as much as you want, as much as you like. In the end, this is, I consider this a kind of informal meeting, so feel free to intervene and make me as many questions as you like. So first of all, I think we should, okay. So first of all, a little bit of economic history. When thinking about the interaction and the relation between finance and macroeconomy, this has been always a controversial relation. In the sense that economic history tells us that there has been many events in the past, even in the far past, of instability, of crises or shocks led induced by financial dynamics. We can go back even to the 17th century, to the first episodes of financial instability. I don't know, maybe you don't know, but one of the first and most famous examples of speculative bubbles, then ending up in a crash, is the tulip bulbs bubble in Holland. There is a famous economist describing these dynamics, Charles Kindleberger. He wrote a very well-known book, Manics, Panics, and Crashes, talking about the many different episodes of financial speculation, bubbles, and then crashes destabilizing the economy. One of them precisely took place in Holland in the first half of the 17th century. And then there are many more episodes. Here I just reported some of the episodes of financial instability that then might have caused protracted recession and crisis. One of them, obviously, is the stock exchange crash in the US in 1929, the Black Friday, then leading after a while to the Great Depression, obviously. More recently, again in the US, 1987, you are too young to remember that, but at the end of the 80s, there was, again, a stock exchange crash. In a way, at that time, people thought we were back again to the 1929 with the saving loans institution crisis. There has been more recently the dot-com bubble, the beginning of the 2000s, and obviously, most of you might remember or know right now the subprime crisis, which took place in the US 2007, 2008, and then spread throughout the world. So, in this case, this is one of the aspects of the relationship between finance and the macroeconomy. Finance always had some form of, destabilizing effects on the macroeconomy as a whole, through this episode of boom and bust financial dynamics. However, it is also true that finance is a fundamental piece of the economy. And without finance, we would not have most of the most relevant progresses and achievements realized under capitalism. Joseph Schumpeter, who was one of the most important economists in the first half of the 20th century, labeled finance, mainly had in mind the bankers, as the heifer of capitalism, in the sense that finance is fundamental in order for the capitalist economy to bring, to carry out innovation. Finance is fundamental to provide funds and to provide resources, to create resources, to the real economy, corporation, to medium, small, or large companies, to carry out innovation, and in the end, innovation, according to Schumpeter, was the ultimate engine and source of dynamism and progress of the capitalist economy. So, finance is obviously fundamental. We couldn't have any sort of progress and evolution in our economy without finance. But it is also true that finance, in many cases, represented a source of instability and then crisis. So, and it is precisely for this reason that from the point of view of the history of financial regulation, we have waves of increasing, more cumbersome regulation and then liberalization depending on the sentiments of the moment, right? If we go back, now again, I mentioned you just a few shocks and a few crises that happened in the history of, let's say, modern societies, not contemporary societies, but modern societies. And that's why, through the 19th century, the beginning of the 20th century, and still right now, there has been episodes of increasing regulation of financial banking activities, and then periods of liberalization in those moments in which economists or policymakers thought that finance, the expansion of the financial sector, was good for the evolution of the economy. If we go back, again, the 18th and 19th century, I mentioned just the crisis, but there are many, many crises. Most of the crises happened after 5, 10 years, much more frequently than what we are used right now. Why? Because at the time there was not yet a central bank, or central banks had different functions with respect to what we are used right now. Now central banks are the providers, so-called lenders of last resort. If financial institutions are in trouble, there could be the intervention of the central bank, calming down the turbulence, providing them extra liquidity if financial institutions are dealing with liquidity crisis, not that much if they are dealing with the solvency crisis, but the introduction and the development of central bank as a lender of last resort in the 19th century and the beginning of the 20th century, this was a huge evolution of financial systems, making financial systems much more stable than what we were used back in the 70s. Again, keep in mind that if you go and read Charles Candelbergen's book, there's a nice report at the end of the book of so many financial crises that happened in England, France, US, through the 18th and 19th centuries, precisely due to the fact that there was not at that time a central bank as we are used to know it right now. Or probably you have heard very recently, due to the bankruptcy of the Silicon Valley Bank, the so-called Federal Deposit Insurance Corporation. This was introduced in the wake of the Great Depression. It was introduced in 1933 by the Roosevelt government. And this was one of the additional steps taken by the Roosevelt administration in order to calm down, if you want, the problems created by the stock exchange crisis I mentioned before in 1929 that morphed into the Great Depression precisely for the lack of intervention of the central bank of the Federal Reserve at the time. The Federal Deposit Insurance Corporation was introduced in 1943 in order to provide insurance of deposit. And in order to avoid what? Something that was very usual at the time, bank runs. Bank runs is the episode in which clients of banks, depositors, go to the bank's doors and ask for their deposit to be brought back home because they fear that banks will go bankruptcy and lose entirely their money. With that insurance, this is not possible. The insurance, hypothetically, is up to $100,000. As you know, if you have news, quite recent news, at the beginning of 2023, when there was the bankruptcy of Silicon Valley Bank, there was an important intervention of the US government extending the insurance above $100,000 and simply telling US citizens, don't worry, you won't lose anything, the insurance will be extended. So this is a consequence of what was historically introduced in 1933, together with, for instance, the Glass-Steagall Act. The Glass-Steagall Act was the first attempt to separate neatly and clearly commercial banks and investment banks in order to avoid possible forms of speculation by commercial banks together with investment banks on financial markets in riskier activities, with the risk eventually that the liquidity that your savings of most people in the economy in the form of deposit could get lost due to speculation taking place in the financial market. But then, after the period, and after I would say 30, 50 years of relatively financial tranquility, there was a big waves, long waves of liberalization taking place via the breakdown of the Bretton Woods system that was conceived by advanced Western economies after the end of the Second World War. The Bretton Woods system broke down at the beginning of the 70s. Long wave of financial liberalization and introduction of many financial products that probably you have heard about. Derivatives, so-called junk bonds were introduced in the 80s. Securitization, the introduction of ABS, asset-backed securities, or CDOs, collateralized debt obligation. These are all forms of innovation, financial innovation, which has been introduced precisely because during the 70s and the 80s and the 90s, we gave financial institutions more degrees of freedom. Even during the Bill Clinton second administration, there were reforms liberalizing the financial sector. The Graham-Leach-Billy Act was a reform removing the separation to some extent between commercial and investment banks. Citicorp was precisely created in the wake of the reform, taking advantage of the possibility of now combining commercial and investment banks again, or some activity of these two parts of the financial system. And then obviously, after the outbreak of the 2007, 2008 financial crisis, we return back to the idea of we have to regulate the financial sector because it is not true that the financial sector always knows what to do best. The Dodd-Frank Act was somehow a return to the Glass-Steagall Act, and then there are whole Basel III and Basel IV reforms. I don't know if you know what is Basel III and Basel IV. These are banks regulation carried out an agreement, this is an international debt agreement between different countries in order to regulate banks, in order to make banks as safe as possible by regulating their own capital, okay, the resources that banks have to hold in order to ensure they are viable, they are solid, and they are liquid, right? So this is a brief history of the waves of restriction, liberalization, and banking, right? It is true, however, that during the neoliberal era, the most economists, or most neoliberal economists, thought that financial liberalization would have been definitively good for the economy, even more so for developing countries. There is an important book written by McKinnon and published in 1973 about the so-called financial repression, claiming that financial liberalization would have been the best choice to adopt, countries should adopt in order to prevent what? Fiscal dominance. Fiscal dominance was the term used at the time to give the idea that government had too much power, fiscal policy was the source of instability, and in order to prevent fiscal policy to give rise to macroeconomic instability, in particular in the case of developing countries, it would have been important to introduce some form of discipline carried out by financial markets. Financial markets, if left free to act, would have disciplined national governments and pushed the national government to adopt those proper fiscal policies preventing instability to emerge and emerge again. Which is the reforms McKinnon was advancing, and that existed at the time, for the limitation that existed at the time. The removal of interest rate ceilings. I will now show you a very simple figure trying to give you an idea of the rationale behind the financial repression literature. Exchange rate restrictions. At the time, there were many more capital controls between countries, impeding capital flows to move freely from one country to the other. There were allocation requirements. Governments could force banks to allocate some of the collected funds in some specific uses, perhaps providing those funds to governmental or public institutions rather than lending them to whatever borrowers banks had in mind. Before moving to the other 2 points, this is a very simple figure giving us an idea of the rationale of behind the financial repression. Right. So I presume that most of you are economists, right? So you are kind of familiar with the saving supply and investment demand, right? So it is a very simplest figure in economics, in which you have the savings and investment on the horizontal axis. So the supply of funds by final savers, right? Common citizen households, right? And those, the demand for funds in order to carry out investments, perhaps coming from whatever firms or corporations you have in mind. This is the traditional distinction between savers and borrowers. Savers, households on one side, and firms, borrowers on the other side, right? And obviously here you have the interest rate. Saving supply is a positive function of savings. The more saving supply is a positive function of interest. The higher interest rate, the higher the interest rate you can get on your deposit, the more you are incentivized to put your money in banks and save them rather than using them for consumption. The opposite is precisely for investment. Okay, for investors, for borrowers. The higher interest rate, the less if they're willing to get in debt in order to carry out whatever investment could be. Now, what happens when there were, and here there is also a gap between obviously the deposits, the interest rate you receive on your own deposits, and the interest rate charged by banks on final borrowers, because obviously banks want to make a profit. Right? Now, let's assume this was the idea of financial repression. Let's assume that there was a ceiling on the interest rate. Let's assume that banks or financial institutions were tightly regulated and they could not charge interest rates higher than house savings.
What happened in that case? It happened in this case that this was the amount of savings generating the economy, right? In this case, obviously, there is the perception of banks as poor intermediaries of funds. So this is the amount of savings collected by banks. This is the amount, the hypothetical amount of investments, but obviously that amount of investments could not be satisfied because there were not enough savings. This is the situation in which we are used to saying the short side of the market prevails. This was eventually the amount of investment carried out in the economy, very low. Why? Because these were the amount of savings permitting that amount of investments to take place. Right? But what happens if you remove that interest rate ceiling? At the very least, if you let the market work free, okay, that was the idea of financial liberalization and removing financial repression. At the very least, you might have an interest rate up here, RB, much higher, intersection of the two curves, and therefore, hypothetically, you might have an increase of both savings and investment up to this point, a star and I star. Okay. Even better if you open your economic system and increase the degree of competition in the financial and banking system. If you increase the level of competition between banks, between financial institutions, the markup charged by banks and the difference between between passive interest rates and positive interest rates will be reduced. The system will become much more competitive, and in the end, instead of the system ending up in point B, it might end up in point C, which is even higher amount of savings and even higher amount of investments. So the view at the basis of the financial repression theory supporting financial liberalization was precisely we have to let the financial market work freely because this will enable the economy to generate more savings and therefore, since that this was a supply-led economy, generate more investment. Investment, obviously, for everybody, are good from the point of view of the dynamics of the economy. Right? This was the idea at the basis of McKinnon contribution, plus, if you want, some other contribution later on in the decades. I don't know if you ever heard about the Barrow-Gordon model. The Barrow-Gordon model is the, how to say, one of the fundamental theoretical pieces at the basis of the monetarist approach prevailing in the 80s and guiding the behavior of central banks in the 80s and right now. When you think about central banks that should prioritize controlling inflation, when you heard that central banks should be independent and take their decision without any influence coming from governmental bodies, this is basically coming from the Barrow-Gordon model. I mean, the Barrow-Gordon model is just one of the contributions, suggesting the adoption of a conservative monetary policy, focusing on inflation and undertaken by central banks which are as independent as possible. Right? And keep in mind that some reforms undertaken in the 80s were very much important and direct in that direction. I don't know if there is any Italian among us, but in Italy in 1981 there was a so-called divorce of the central bank of Italy, the Italian central bank with respect to the government. Before 1981, the Italian central bank had to purchase on the market all government bonds that remained unsold, which is obviously a significant help provided by the central bank to the government in order to financing potential fiscal deficit. This was the idea of fiscal dominance. The government could spend much more because they were backed by and supported by central banks. Again, in Italy, the Italian central bank had to purchase by default a given amount of government bonds. This is another example of a fundamental support provided by, at the time, the Italian central bank to the domestic. So, all these, interventist approach that by regulation the Italian central bank had to take on financial market in support of public spending, they were precisely removed with the intent of fighting inflation and creating a financial system more focused on inflation and more complacent, if you want, with public spending. Too much public spending. What was perceived at the time as too much public spending. More recently, Levine wrote an important book about financial development, the so-called financial development literature in line with what I told you before. And this statement, I think, is a kind of telling. So the idea is that financial development was, by mainstream economists at some point, perceived as always beneficial and as always good, because in the end the expansion of the financial sector represented the possibility, the provision of finance, the provision of loans, also to those economic actors which were usually excluded by formal financial mechanism. They could undertake any kind of investment plan or small, even small expenditures, and this would have led to a reduction of inequality. Right? Any question? Can you still resist a few more minutes? I mean, a few more minutes. 10, 15 minutes. I mean, I know it's 6:35. I mean, in 10, 15 minutes, we can close and then move to whatever question you have. So, yeah.
How is what the Italian central bank was doing to kind of boost the bond purchasing? How is it different from QE now?
Well, de facto, the effect was the effect is the same. The fact is the same. But QE now, right now, is a kind of temporary measure. Was conceived as a temporary measure precisely because inflation expectation, at least when it was launched in the eurozone in 2015, it was introduced precisely based on the justification that inflation or better inflation expectations were too low, and therefore it was conceivable for central banks to intervene. It is also true that at the time, however, there was still a restriction imposed to fiscal policy because there were fiscal rules implemented by the eurozone. Governments could not exceed, could not run a deficit larger than 3%. So in a way, true, there was the possibility for central banks to intervene much more strongly on financial markets, and this obviously provided a big help to government, but this was justified just because the inflation, expected inflation was too low, according to the 2% target, and secondly, taking into account governments were still restricted and were still told to implement the 3% fiscal rule, 3% deficit fiscal rule. Okay, so they are not comparable, even because keep in mind that during quantitative easing, central banks intervened on the so-called secondary market. They could not purchase directly government bonds from the government. They collect government bonds on the secondary market from other institutions. It's not a direct loan. It's not a direct credit going to the government. Okay, so it's something different with respect to what happened before the 1981, even though some of the effects are obviously similar, the reduction of interest rates, and making, in some way, public spending more easier. Right? Yeah. Okay, we already did that. Now, what happened is that obviously, in particular, but not only with the outbreak of the last financial crisis, or the so-called great financial crisis, there was the perception in some economists that there was an overexpansion of finance. And that's why some economists came up with the expression, with the term financialization. And this is probably the most famous expression, the most famous definition of financialization provided so far by Gerald Epstein, who is an economist at the University of Massachusetts Amherst, defining financialization as the means the increasing role of financial markets, financial actors, and financial institutions in the operation of the domestic and international. So obviously, financialization is generally confronted with financial development because this represents a negative interpretation of finance, or better, a negative interpretation of the overexpansion of the financial system. Okay, a financial system which is increasingly disconnected with the needs of the real economy. Okay, and could become a parasite for the economy. I'm taking advantage of some figures included, some tables in this case, included in a book published in 2013 by Thomas Palley, in which they provide to some extent a good representation of what could be financialization, or at least two forms of financialization. One is this: the increasing importance of the so-called finance sector over GDP. FIA is finance, insurance, and real estate. An increasing part of GDP came, at least in 2007, then a bit less after the outbreak of the last financial crisis, an increasing part of GDP was generated in the so-called FIA sector. Okay? So, representing, telling us, well, finance, or more broadly the FIA sector, is becoming an increasingly important part of our own developed countries. Okay? Is there a justification for this? This is one of the questions which we could try to address. And is the FIA sector expanding because it's providing more credit to the real economy? Well, not really. As you can see here, there is an increasing importance of finance created for the sake of other financial institutions. So it is a kind of inner circle inside finance. Financial institutions are increasingly creating finance, the benefit and for the needs of other financial institutions. So that credit seems not to circulate in the real economy. It's not the standard representation of credit as in the previous figure. So banks collect credit, let's say, savings, and then intermediate them towards the real economy, typically firm. This is right now a complete misrepresentation of what happens in the financial sector. And if you want, the idea that credit is created at the benefits of other financial institutions could be an idea at first sight of a first indicator of the overexpansion, unnecessary overexpansion of the financial sector, and therefore of financialization. Financialization took and takes many different forms. For instance, there's the idea of the financialization of every day, an increasing amount of services and functions are performed thanks to the intervention of the financial sector. Obviously, there has been a huge increase in the real estate thanks to mortgages, an increasing amount of mortgages provided to households. There is an increasing amount of consumption loans, of student loans. Back in the decades, students didn't have to get indebted in order to attend schools. They didn't have to take a government loan or get indebted with financial institutions, right? Or the need of recurring to private insurances in order to afford some healthcare services. And yes, this is kind of clear, right? Another form on which I focused upon in my research activity is the so-called commodification of or securitization of financial relations. Financial relations created by some financial actors, typically commercial banks, are then transformed in assets that could be sold on financial markets. This is the idea of mortgage-backed securities, or CDOs. I don't know if you ever heard about them. This is the so-called change or move from the originator and hold system in general commercial banks, where those institutions creating credit on behalf of the benefits of households or firms, like mortgages, they were used then to hold all the mortgages generated till maturity in their books. With the move to the so-called originator and distribute practice, they generated mortgages, but then mortgages were bundled in some complex financial products like collateralized debt obligation and sold on financial markets and purchased by some other financial institutions. Okay, and why? Which was the purpose of this? Well, because if commercial banks can get rid of some of the mortgages created in the past, they have more space in their activity, in their managerial activity, to create more loans. So there is the possibility to generate more and more credit provided to the economy, with some risk of financial instability. Or alternatively, another form of financialization is this called shareholder value orientation. The idea that in the management of companies, there is increasing importance attached to the interest of shareholders. How many times probably you have heard it is important to create value? Now the mantra of businessmen is creating value. We have to create values for our shareholders. That's the idea of shareholder value orientation. And how can you create value? Well, basically, distributing higher dividends, undertaking some actions that could increase the financial market values of the companies, such that then shareholders could realize capital gains. That's the idea. Okay? And obviously there is here a negative perception of that because a higher shareholder value orientation could come at the detriment of real investments, of innovation. William Lasnik is a US economist which put together with Mariano Mazzucato, wrote extensively. Mariano Mazzucato here at UCL at the Institute for she's the director of an institute here at UCL, but now I don't remember the name of the institute.
Public policy.
Exactly. Innovation and something for public purpose. Institute of Innovation for Public Purpose, IIPP. It is. So Mariano Mazzucato wrote extensively with Will Lasnik on the shareholder value orientation. Or alternatively, even mainstream economists realized that too much finance could be detrimental for economic progress. There are this first contribution, first of all, stressing that how there could be a perverse reallocation of high-skilled people away from those sectors that could give rise to more innovation, let's say welfare-enhancing innovation in the financial sector. How many mathematicians, engineers, physicists are now hired by financial institutions rather than find a job more naturally, I would say, in the manufacturing sector or in those research-oriented sectors? Or, according to my most recent contribution, there could be some long-term effects of periods of financial booms, in particular in developing countries, in the composition of their economies. In periods of so-called financial bonanza, when there are surges in capital inflows towards developing countries, the sectors which get benefited are the real estate or the services, rather than those sectors that could help the economy to progress in the long run. I would say some kind of manufacturing. These are some of a figure taken again from Paley, giving you an idea, according to Paley, of the perverse effects of financialization. A redistribution away from labor and towards capital, but there is also a conflict inside capitalist class itself. A conflict between those receiving interest rather than profit, so more indebted companies paying out higher interest and using less profits in order to carry out their own investments. And there is, if you want, an intra-capitalist conflict between industrial capitalists, if you want, and the so-called rentier. Okay? Those who are getting some form of income simply because they are owners of financial assets. Right? Obviously, this redistribution of income could have negative consequences in terms of inequality, and this is precisely one of the outcomes of my research. This is a figure included in a paper co-authored with many other economists, Eugenio Cavazzasi and Alberto Russo, Mauro Calegatti, and Joe Stiglitz. These are not real data. First of all, I want to clarify that these are not real data. These are the result of a complex, so-called agent-based stock flow consistent model, which is a kind of complex technicality, but doesn't matter. And this is the idea of how much securitization could give rise to increasing inequality, both income and wealth inequality. Here there is the representation of two different systems, one without securitization and without the creation of complex financial products I mentioned before, asset-backed securities or collateralized debt obligation, and a world with financialization, with securitization and the creation of those financial products. Why inequality, income and wealth inequality increase in that system with securitization and the creation of those financial products? Because those financial products are precisely meant to redistribute income from households, low middle income households, if you will, which are indebted towards commercial banks, but those assets are not held any longer on the balance sheet of commercial banks. They are securitized in order to produce complex financial products which are meant to remunerate the appetite for rent coming from wealthy households. So the interest you pay on your mortgages, in the end, could end up hypothetically in the wallet of wealthy households who purchase asset-backed or market-backed securities on financial markets. Okay? produced by using original models. Even this is a result of one of my final contributions together with some of the previous authors. Again, this is the results of another agent-based stock flow consistent models. If you are interested, I will provide you with the details of this contribution. I want to focus on 2 points. First of all, again, here there is the comparison between the world with securitization, the red line, and the world without securitization. And which are the consequences? The consequences for the dynamics of the economy are important. Because as you can see here, there is a system in which there is an increasing amount of loans provided to the economy. Securitization is precisely meant to enable the economy to create an increasing amount of loans, but the provision of loans and credit to the economy becomes increasingly unstable. You can see the volatility. And paradoxically, there is a consequence for the dynamics of the economy. Monetary policy becomes less effective, because since that, with the increasing interest rates, those financial products becomes more appealing. There is a higher demand for securitization, and there is a higher provision of loans to the economy. And therefore, interest rates are persistently higher. The results of these simulations, inflation is persistently higher in the system with securitization in the economy, with financialization. I would say there is a persistently higher inflation rate in the economy financialized with securitization than in the system without securitization. And this has important implication for the conduction of monetary policy, because monetary policy, the governor of the central bank could be forced and pushed to charge a persistently higher interest rate in order to tackle the persistently higher inflation in their economy, characterized by financialization. And therefore, you are in a kind of perverse circle. The more you increase the interest rate, the more securitization is incentivized, and this could give a boost to the economy up to the crisis. But the more this process is fueled, the higher will be the interest rate charged by central banks in order to try to avoid this to take place.
Sorry, are these forecasts or are they real data?
No, these are not real data. These are just simulation. Okay. These are simulation. This is a virtual economy. And these data are not meant to reproduce any real economic dynamic. Okay. So,
just economic experiment.
Yeah, exactly. This is just an economic experiment. So take this with some grain of salt and with caution, because obviously this is a qualitative analysis of what might be economic dynamics in an economy with and without securitization, but this is not meant to reproduce any real data. Right? It is a... Yeah, please. Sorry? I can't hear you. Yeah. Yes, and in fact, now I don't show you the data. In this case, with higher interest rates, inequality is much higher. The interest rates have a much bigger impact. I mean, interest rate has a stronger impact in the economy in the sense of redistributing income from indebted households towards relatively richer households who can purchase financial products on financial markets. What securitization inhibits is the control of inflation via moving interest rate. If you want, the policy suggestion coming from this publication is that given the current functioning of financial markets, it could be wrong to give central banks full responsibility for controlling inflation. If we want to control inflation, controlling inflation could be done by a mix of policies rather than asking central banks just to take full responsibility for this task. Okay? And this is also recognized again. There is more recently some form of consensus between many different economists, not only heterodox economists, but also mainstream economists, that financialization or financial liberalization could be particularly instrumental for the stability of developing countries. Jonathan Ostry was chief economist, I think it is still chief economist at the IMF, and he produced several contributions suggesting, look, actually, after many decades, we should recognize that the liberalization of financial flows between countries didn't bring those positive results we expected. Actually, they increased the probability of crisis here and the level of inequality as a consequence of the Alberto-Botta crisis. Okay, this is an important contribution written by Jonathan Ostry and other two co-authors, and the title of the contribution is Neoliberal Unsold, Oversold, I think, something like that, but anyway, interesting consideration. Moving to the end, this is also related to one of my final contributions, the idea that precisely in periods of financial bonanza, of surges in capital inflows towards developing countries, there could be episodes of so-called premature deindustrialization. Countries, in this case in Latin American countries, that start to deindustrialize much earlier than expected. Now, obviously, we may have different views about the pros and cons of industrialization, in particular in time of environmental crisis, but I would consider, as a development economist, I would consider industrialization as inevitable, as a kind of, more than inevitable, as the necessary condition for some countries to develop, to reach the status of fully developed economies, because the development of industrial sector and of manufacturing in particular is fundamental in order to give rise to the so-called formal sector, to generate employment, to give rise to the increase in productivity, which is fundamental in order to increase living standards. Take the example of China, or the of East Asian countries, These are some figures, but in this contribution there are also more data about Latin American countries in particular, in which it seems that financial liberalization and the exposure to periods of financial bonanza, which are these dark areas, contributed, exacerbated in some cases, trends deindustrialization, or made the deindustrialization take place earlier than would have been expected according to the historical example provided by developing countries. Coming to the end, and then opening the floor to for the discussion. I think it is important here to remember the contribution of a very important economist who is Hyman Minsky, who is a so-called post-Keynesian financial economist, because he dedicated most of his life to studying the destabilizing effects of finance. To some extent, Minsky suggested that the relation of finance with the real economy will always be controversial. And finance will always have the, tendency of generating financial innovation in particular, will always have the purpose of increasing the margin of flexibility of financial institutions, margins of maneuver of financial institutions, increasing profits opportunities, which by itself are not bad, are not a negative things by themselves, but this could come at the cost of generating speculative bubbles. And that's why Minsky always advocated the fact that regulation must be constantly updated and changed according to evolution in the financial system in order to tackle the possible destabilizing effects of financial innovations. And it is of paramount importance having big governments and big central banks keen to intervene in order to tackle the intrinsic risk that characterize a capitalist economy. Yeah, obviously, from a theoretical point of view, there are completely different views of the capitalist economy with respect, let's say, mainstream economists and most of the models used by mainstream economists. There was a nice, I would like to mention as a final point, something that Joe Stiglitz wrote quite recently. Most of mainstream models, it's like if you go to your GP and your GP could tell you, sorry, I could take care of cough or some minor disease, but I don't have the tools to cure cancer or whatever, right? And this is precisely what you want to expect from a doctor, right? So that's the paradox of the most mainstream models, which have the capability to detect and solve minor problems, but not the systemic instability risk characterizing typically and traditionally capitalist economy. I stop here, and then for question or whatever you like. I couldn't include a slide with those references, but if you give me one more day, I will have that slide. If you want to circulate slides among yourself, and I will have those contributions such that if interested, obviously you can go through them and read them.
So if anyone is interested in getting the slides, please just drop us an email and we will forward them through. Okay, so any questions to start?
Saving capitalism back from itself. Right? Others are saying that capitalism is fundamentally right and there might be mania problems related to exogenous shocks. No, there's nothing exogenous. Everything is in the system.
Can I ask a follow-up?
There is another question in the back before.
Yeah, after.
Is feasible?
Good question. I think that I remember something that one of my bosses at the University of Greenwich told us during an event, and I think she's right. She said in this talk. Well, I think the priority in developed countries is not that much about growth, but it is more about decent jobs and a more equal distribution of resources. I do agree with her. So growth for developing countries is a completely different thing. Because again, as I told you before, I think that industrialization and manufacturing development is the precondition for development. China experience is clearly telling. East Asian countries is a clear evidence of this. So growth is absolutely necessary in the case of developing countries. This is not only the case from a personal point of view of developed countries. We could be in what Rafa was used to say, the circular reproduction. So without having too much growth, I presume we could still live quite decently. The problem actually here in developed countries is the redistribution of wealth and the redistribution of income. So I would definitively go for a much stronger intervention of the public sector. I mean, then I will give you a follow-up on public intervention of the economy, because there is also this debate that the public intervention in the economy is always negative. Reduces efficiency. Because I'm telling you that the train transportation in the UK are efficient, the train system in the UK is efficient, or energy provision in the UK is efficient. In the UK, not only in the UK, in many countries, there are studies, serious studies, econometric studies, saying and suggesting that in the end, privatization of some sectors of the economies decreased efficiency. Because obviously, if you create a monopolistic power, it's not the way ahead. In some cases, the kind of innovations and the kind of efficiency achieved by public companies was much higher. And therefore, the belief that the market mechanism would have fixed all the problems of the economy were definitively misplaced and misleading. This doesn't mean that all public companies were efficient. Again, it is a matter of taking case by case, considering the different institutional features of different countries. But the evidence is telling us that in many cases, at least in Europe, the idea that privatization would have solved the main problems of efficiency turned out to be completely wrong. Completely wrong. And we also have to consider the goals of public companies. If public companies provided some services in some deprived areas, well, obviously efficiency is lower, because the way you measure efficiency is that, if you provide transportation service in an area without any private transportation, obviously probably that kind of public transportation is used just by a few bunch of people, but still you are providing a service. probably we are suffering a loss, possibly compensated by intra-public sector transfer. But is it good or not? Otherwise, then you need everybody to have their own car, to move with their own car, and which are the consequences in terms of environmental damages. This should be something that should be evaluated in a much broader way and taking into account different goals that by definition public companies should pursue. Because I'm perfectly fine if some public companies suffer losses or do not make profits because they are not expected to make profits, and that's absolutely fine to me. I don't want necessarily to make profits. Private companies have to make profits, and it is absolutely legitimate. They are absolutely legitimate to make profits. I'm not saying this. But in some sectors, it's much better if there were the intervention of the public sector not making profits, or using profits, making profits and redistributing it for other services. There are cases of communal pharma services making profits and use those profits in order to expand the healthcare system in some Italian region, for instance. I would love a system like this.
I'd just like to ask a question about Keynesian economics.
Yes.
Because I'm kind of looking at economics from the outside. I'm not studying it, but it's interesting, and I like reading about it. And when I read Keynesian economics, I feel like as a post-Keynesian economist, you will be able to explain this, because I feel like there's like inherent flaws, right? Stuff doesn't add up. Like in terms of how they look at economic growth, for example. Only when there is economic growth can there be inflation, according to Keynesian economics. But then you have reality, like now, periods of low economic growth or negative economic growth, where you also see inflation. So obviously all theories can't explain reality fully, but what corrections does economics now, like as a discipline, do they offer to this incongruency?
Okay. First of all, a suggestion. Maybe you will become members of Rethinking Economics. So I think it is fundamental for Rethinking Economics to push for some reforms in economics curriculum. Because now in many economics programs, there is no any longer history of economic thought, there is not any longer economic history. And for me, this is a tremendous mistake. Because in the end, some modules used by central banks are based on old economic theories. Knut Wicksell was the Swedish economist introducing that kind of theoretical apparatus used right now by research divisions at central banks. So the so-called VSG models, in the end, in the back, they have the ideas developed at the beginning of the 20th century by Knut Wicksell. Wickellian models, most VSG models are Wickellian models. Therefore, in order for you to understand very well which are the theoretical and the mechanism behind VSG models, which are the models currently used by central banks to give policy advice, you should know which were the thought developed by Wicksell at that time. So history of economic thought is fundamental. And history of economic thought would also be useful to make you understand clearly which are the difference between new Keynesian economics, post-Keynesian economics, and other economic theories. Then it's your choice to decide, according to you, which is the best one. The problem is that most of the theories are not taught any longer in programs. And this is a big problem, and that's why rethinking economics is important. Because rethinking economics should look for economic pluralism. Try to describe me, not everything, but at least the evolution of economic thought, because this will enable me to appreciate which is the best economic theory which could possibly explain current problems or previous ones. Okay. Obviously, there were some events back in the 70s that traditional Keynesianism could not explain. The so-called stagflation. Stagflation was apparently unconceivable according to all Keynesian economists. The combination of stagnation and rising prices was something that was not very well understood by Keynesian economists. And this was a major defeat of that. I don't think that post-Keynesian economics has all the responses to what is going on right now. The combination of stagnation and rising prices. I think that to some extent we are in a similar condition with respect to the 70s. The fact that there is a combination of higher inflation and stagnation, however, doesn't imply that the fundamentals of post-Keynesian economics are wrong. Okay. There are some explanations provided by monetarist economists and monetarist economists that apparently looks fine and makes sense, but their bases are extremely fragile from my personal point of view. So what is appealing at first sight could be in the end be wrong. That's my impression. I'm telling you this because right now, there is this problem of increasing prices and recession, but this could be an example of correlation which is not causation. If you study economics, you see that there could be two events taking place at the same time, and they could look like correlated and connected each other, whilst there is a problem of an omitted variable causing them at the same time, but it is that omitted variable causing them without them being necessarily connected to each other. I think this is the problem. So obviously, now there is a massive problem, there has been a massive problem of increasing prices. Given our institutional features, central banks had to intervene massively, and again I'm saying had to intervene massively because this is in the mandate of central banks. So central bankers simply did what they were asked to do, try to tackle inflation by increasing interest rates and leading to recession. Okay. Now there's evidence that inflation has many economic variables. There is hystericism there. It takes a lot. It takes some time to go down to the initial level, to acceptable level, or whatever. So, and to some extent, this could be interpreted via post-Keynesian economics. Right?
Do you have any questions? Right. I know we're running out of time, but is it okay if I ask a question?
Yeah.
Yeah. So I was just wondering about, my question is about institutional economics.
Yes.
And I first came across institutional economics when we started rethinking economics,
Okay.
but I'm still trying to understand the differences between institutional economics and mainstream economics. So what are the core principles and concepts that make them different?
Okay. So I will try to respond to this question, even though it is a little bit outside my area of expertise. So I'm not 100% sure of what I'm saying here. I would say that institutional economics is a kind of transversal topic in the sense that it is a transversal field of analysis that could be that could develop across many different schools of thoughts. The importance of institutions is recognized both by mainstream economists and some heterodox post-Keynesian economists. So institutions are of paramount importance in many different economic thoughts and economic schools. And there might be many different ways taken by these different schools. First of all, what are institutions? What are at least the important institutions for economic development? Economics is related to the contribution by Daron Acemoglu, for instance. Daron Acemoglu could easily tell you the most important institutions are a clear definition of property rights, governmental institutions which are not extractive, and competition, right? Fair competition. There have been contributions written by Darren Ajamong, according to which property rights, intellectual property rights, and patents policies are very much important to stimulate growth. There was an important contribution about the fact whether a more cutthroat system would be preferable with respect more socialist system like Northern European countries. And he said, look, for the benefit of the international economy, not all countries could be socialist. Okay, so socialist is not the right term used, but to say more paternalist countries, let's say, more paternalist institution. There must be, at least at international level, a more cutthroat system incentivizing and generating innovation. There were some responses coming from economists and experts in political sciences from LSE, for instance, saying no, it is precisely the opposite. If you take other measures of innovation, more egalitarian Northern European countries do way better than the US in terms of the generation of different types of innovation. If innovation is not measured just by the number of patents generated and registered in a year, but you have a more complex measure of innovation, those countries are doing much better than the US. So, why I'm telling you all this? Because it depends also on what you consider good, important institutions. From the point of view, and this is also a problem of heterodox economists, good institution could be many more different things. Good institution could be responsible government, some kind of monetary policies feeding productive development, something that won't be considered in general by mainstream economists. So the divergence between those school of thoughts also depends on what you think, what you define as institutional. If you adopt a narrow sense of institution or a broader sense of institution, and what you consider good or bad. There is a wide discussion about corruption in economic growth. Is it corruption good or bad for growth? In some cases, most of you would say, well, corruption is definitively bad. Some others would say, well, corruption is everywhere, exists in all the countries, even successful economies in South Korea. It depends which is the purpose of corruption. Corruption, in a way, was functional for economic development. In the case, it could apparently turn out as a virtuous, at least for some time, aspects of the economy. Right? So it's not easy. There are also convergences between economic schools. Institution could be controls of capital. Now there is increasing agreement between mainstream economists and orthodox economists that some forms of capital controls are necessary. The contribution I mentioned before by Jonathan Ostry is indicating that in particular speculative capitals are not beneficial for countries. And therefore, even though in the 70s and in the 80s, mainstream economists, neoliberal economists, mostly advised to liberalize completely your economic system, now they return on the idea that some forms of capital controls, not FDI, but the most speculative forms of capital controlling the most speculative forms of capital flows might be good and welfare improving for economic system. This is the form of institution on which now there is a kind of consensus between different stream of thoughts.
Thank you. Unfortunately, that is all we have time for today. Thank you so much.